Hello, my name is Matthew Copley, President and CEO of Copley Financial Group. And today I'm here to do a market update. I'm here in my ugly Christmas sweater. We're actually having a potluck here in the office for all of our employees. And so I thought I would step away and do a quick update for everyone on what's going on. There's been some big news in the economy, lots of economic data. We want to go over that and how that impacts you and your investments. We also want to cover some of the new numbers as far as what we're seeing in guaranteed interest rates, what the buffered indexes look like. We have the new barrier product that has that 185% participation rate on the S&P 500. So we're going to discuss that. And we'll also talk about some opportunities that we may see to actually get some great returns in different parts of the market. A quick update on our new office. We are going to be most likely moving in March. There has been some delays with the contractor. We're hoping to move in January. This is going to push back our open house. And you may have seen in our previous video regarding the plan that we have to change from a client appreciation dinner, which we normally do in January every year, to a grand opening, which now will probably take place in April. So look out for that. There will be dates that go out on the open house in the new office. We also have some big news. Our broker-dealer was approved. So Copley Alternative Investments was approved by FINRA. So we will be transitioning from Emerson Equity to a new broker-dealer that we own and control and do our own due diligence on. This is going to allow us to offer some really great alternative investments and be able to do a lot of our own due diligence on those investments and really dive in and look at them closer. So we're excited about this. We also can potentially work with other advisors around the country that might be able to route their business through us, giving us an opportunity to grow. And it's great timing with the new office that we're moving into and the broker-dealer getting approved. We've got a lot of exciting things going on here today. Of course, the big news that everyone has been paying attention to is the Federal Reserve announced a interest rate cut of 0.25%. This was not unexpected. Everyone expected this. The market actually priced all of this in. Everyone expected this to happen. And so what that does is the Federal Reserve has lowered short-term interest rates, which helps the government finance more debt. It does not help the mortgage rates, and this is important. There's a big difference between short rates and long rates. Short rates are typically T-bills. These are rates that are used to finance government. Most of the government spending is done through T-bills, and everyone looks at the numbers and says, oh my gosh, there's $9 trillion in treasuries that have to be reinvested this year. How can we possibly afford this? The country is going to be insolvent. Well, almost all of that just simply gets changed over into new treasuries. And these are in our money market accounts, it's in the banks. And so this is something that happens behind the scenes. This is a simple process. And so the short rates are really about government funding. Long rates, these are more the treasury bonds. These are the things that affect the 30-year mortgage rates, the treasury notes. This is the longer duration U.S. treasuries. Those are not going to be impacted by the Federal Reserve lowering rates. In fact, those would only be impacted if the Federal Reserve started buying some of those longer duration treasuries. And this is the big news that I think a lot of people missed. Everyone's talking about this lower interest rate, but the real news is the Federal Reserve restarted quantitative easing. I talked about this in many previous videos that I expected the Federal Reserve to actually restart quantitative easing. I just didn't think they were going to stop quantitative tightening and start quantitative easing at the same time. So this was actually a surprise. The government is going to be printing up a lot of new money, and this new money is going to be used to finance government spending. And so they're talking about $40 billion a month. This is a big number. At the height of all the money printing during COVID, it was over $100 billion a month. So $40 billion is not quite as big, but this is very inflationary. When you start printing a bunch of money out of thin air, it creates inflation in the economy. And so that is exactly what the government's doing. I noticed that they prefaced a lot of this as, well, we're kind of concerned about inflation and Trump's tariffs. Well, tariffs do not create inflation. That's ridiculous. Tariffs are deflationary. The money printing, that is what causes inflation. So it's very, very important to understand when the government creates all this new inflation, it is going to cause prices to go up on everything that we buy, from groceries to gasoline to airline tickets. So I'm going to talk more in this video about what we're seeing on the current inflation numbers and how this new money printing might impact this. And by the way, the government's not calling this quantitative easing. They're saying, oh, we're just going to manage the Federal Reserve's balance sheets, and we want to make sure. They already have $6 trillion on the balance sheet. What are they talking about? What's an extra 40 billion? This is ridiculous. And the real answer is yeah, it shouldn't be called quantitative easing. I agree. It should be called what it actually is: debt monetization and money printing, which is exactly what it is. The other big news that everyone seems to be talking about is the employment data. And the employment data on the surface does not look very good. In fact, the government reported that we lost 64,000 jobs last month. They reported that unemployment rates are now up to 4.6%, the highest level in many, many years. But if you actually dive into the numbers, they tell a little bit different story. So when you look at the actual numbers, unemployment claims are actually way down. They're collapsing. So what's going on there? And when we look at the actual unemployment numbers, is it really that we lost 64,000 jobs? Well, inside that data is a loss of 270,000 government jobs. So there was enough job increase in the private sector to make up for almost all of those government jobs that were lost. Well, government jobs do not benefit the economy. And so losing government jobs do not have a real impact. In fact, the fewer government jobs there are, typically that is a positive for the economy. So the unemployment data actually doesn't look quite as bad as what you might think on the surface. Now, how is it that unemployment claims are going down at the same time that unemployment is going up? And this is because a lot of the people that are losing their jobs are not US citizens. In fact, there's a lot of people that are probably afraid of collecting unemployment. They're afraid of going to collect it because they're not in this country legally, and they're worried that maybe ICE agents are going to come and see where they're at if they try to apply for unemployment benefits. So I think there is a lot more people losing jobs than what those unemployment claims show. And that's because of the fact that you're seeing a lot of job loss among people that are not in this country legally. And so we are seeing the numbers as well as far as the number of people. It looks like about 2.5 million people have actually left the United States. These are people that were not here legally. In fact, believe it or not, more than 1.5 million of those actually self-deported. There's actually programs the government has used to give people money and incentives to actually leave the country voluntarily. And so when you have this big loss of people leaving the country, you're going to see unemployment spike up in some of the numbers, but it doesn't necessarily affect the actual economic data because these people are losing their jobs and then leaving. Now, the other big data that just came out is the recent CPI data, and this was a surprise. It was a surprise to almost all the economists and analysts on Wall Street, and it was a big surprise to me. I did not expect inflation data to come down this much. We actually expected inflation, and all the analysts were looking at about a 3.1% expected inflation. That has come down to 2.6%. That is a big drop, which is really unexpected. And this is not just because energy prices are coming down. Believe it or not, this is data from a month earlier when energy prices were still a little bit higher. In fact, the next data print we get is probably going to be even lower inflation because of the energy prices coming down. And so inflation data looks really, really good. This is really good for the economy when you're seeing prices not going up nearly as fast. Now, you still have all these higher prices that we got over the last 5 years, 6 years. We've been getting a lot of increases in prices. We've seen some big inflation. That is here to stay. The prices are not coming down despite what Trump and some of the politicians say that they're lowering prices. prices are not lowering, they're staying up, they're just not going up as fast, which is a good thing. Now, there are some things that are coming down, and the big one, of course, is energy prices. Gasoline prices are coming down. We're not really seeing that much in California because as fast as gasoline prices are going down, gasoline taxes are going up here in California. But we are seeing some big drops around the country in states that do not charge as much in taxes on gasoline. So you are seeing some real positive data in inflation. And I did mention earlier that tariffs do not create inflation, and the evidence is clear now with all of the data that tariffs did not increase inflation at all. And I really want everyone to understand kind of how this works. And I've got a real simple analogy that I want to really get everyone to understand how tariffs do not impact inflation. And here's an example. Let's say that I have $100 and I have 10 things I want to buy, and each of those 10 things cost $10. So this is something I'm used to buying. I've got $100, 10 different things, $10 each. Well, let's say that half of those things are actually manufactured outside the United States and are now going to be subject to tariffs. And let's say those tariffs are going to be 20%. So now the things that cost $10 are now going to cost $12. Now, on the surface, this is inflationary. Things are going to be more expensive, but that's not actually what happens. And the data proves this. Here's what actually happens. Those 5 things that now cost $12, those producers are going to say, well, gee, we still want to sell things to the people in the United States. Is there something we might do to reduce our costs? Can we reduce our expenses? Can we shrink our profit margins? Can we figure out ways to offer this product for a little bit less? And maybe they're going to offer it for $11. So part of it will get increased. So we're going to pay a little bit more, but not the full tariff. What ultimately happens is maybe we pay $11 now for those 5 things. So it's $55 for things that used to cost $50. Well, that's inflationary. But here's what happens. Now I have less money to buy other things, all the things that were made here in the United States. And those things that used to cost $10 each for these 5 things, those companies are saying, wait a minute, this person doesn't have as much money to spend. Is there something we can do to potentially reduce our costs, lower our prices, figure out ways to make our company more efficient? Can we offer our products for $9 instead of $10? And that's exactly what has happened. We're seeing this in the economy. Now we have 5 products that are $9 each for $45, and we have 5 products that are $55, $11 each. And so it's the same $100. There's been no inflation. The prices on everything has technically gone down, and the difference has gone to the government. And this is my problem with tariffs. This is my problem. It's not inflationary. My problem is this is taxation. What happens is the money that is generated now goes to the federal government, and they get to spend that money. And we're seeing record numbers going in, way more than anyone predicted. The US government is collecting a lot of money in tariffs. And my concern is that we're collecting all this money in tariffs, and what is the government going to do? They're just going to spend more money. And this is the real problem. This is the real reason that I'm against tariffs. I think this is a bad idea because it's just a way that the government increases taxes for all of us. But ultimately, it is not inflationary. What is inflationary is the quantitative easing, the Federal Reserve printing more money, the $40 billion a month in additional money printing, debt monetization that is going to go to the government that they're going to spend. This is what's going to create inflation. So the tariffs can actually be deflationary at the same time the government is going to spark inflation with all of their money printing. And that is really how you understand what's going on with these Federal Reserve changes and these inflation data numbers. One big news item that a lot of people probably missed, it wasn't as big a news as some of the other stuff like the Federal Reserve and the CPI data, and that's the announcement that Elon Musk is considering doing an IPO on SpaceX, and he's announced his plans to actually put data centers in space. This is a really interesting concept. I actually got excited about this initially. I thought this is a great idea. Putting the data centers in space, they can create unlimited energy at the right orbit where you're just always getting energy from the sun with big solar arrays, and then you actually put all of the actual data centers, the servers, the chips, all of it up in space. This is a great idea. and you got all this energy. This solves the energy problem that we need for all these data centers. And in space, a lot of this equipment that needs cooling, and this is a big part of these data centers. It's not just the energy, it's the fact these things have to be cooled. There's a cooling process that takes a lot of energy to cool these things down. While up in space, it's a lot easier to cool things. So this is a great idea. So I started looking into this. I thought, this is great. But then I started to do the math and actually look at the numbers, and I don't know if this is viable. I mean, you're talking about $70 million for every single Falcon rocket launch. You're going to spend that kind of money just to launch these things up in space. And what if there's a malfunction? What if there's a problem? How are you going to repair a satellite that's orbiting the planet up in space? I mean, this to me seems like a very expensive proposition. Now, I don't know the profit margins on these rocket launches. I don't know how much of the money on the rocket launch that's being charged is actually profit for the company. So maybe they can get away with doing these rocket launches a lot cheaper. Maybe they can come up with a way to mass produce a bunch of rockets and actually get more of these up into space. It's interesting. It's something I'm definitely going to watch. I think it's a big deal. If they can actually pull this off and actually get these data centers in space, it could be a very big deal. It could be huge, huge benefit for artificial intelligence and the ability to do a lot of the things that they want to do that we simply do not have enough energy to accomplish. But I do want you to understand that energy is still going to be something in massive demand. And just because we might actually be able to move some of that energy demand out into space and be able to use the solar arrays to actually power some of the data centers, you need to understand that oil and natural gas is still going to be a major part of energy production in the world. And the fact that oil prices are now very, very low, they've come way down in the last month. We're seeing now oil prices below $60 a barrel on US crude. That is a very low number. This is beneficial for the economy. This means that energy is cheaper for everyone else in the economy, all the businesses that need energy. This is a very positive thing. Now, oil and gas is going to be a big part of it. Why? Well, I was born in 1976. I'm going to be 50 years old next year. And if you look at how much of the electricity that was produced in the United States came from oil and gas when I was born in 1976, it was about 81% of all the energy produced came from oil and gas back then. Today, it's 79%. So all of the money that we've spent on all the solar and all the wind and all the green energy, it's managed to get us an extra 2%. That's it. You still have 79%. This is a very big number. You need high quality baseload power. It comes from oil and gas. It is possible to have nuclear energy come into the picture at some point to help with this, but oil and natural gas is a really good investment. I think now is a good time. You're seeing a lot of these oil companies trade at low numbers. So we are looking at these. I think there's a real opportunity in energy production. And there's one other thing that's important with energy. About 25% of the planet does not have reliable electricity, and they want it. They want reliable electricity. And the bottom line is, how are they going to get it? They're going to get it through oil and natural gas. And those people are going to demand electricity just like everyone else in the world. They're actually on the internet. It was amazing when I was visiting Zambia, Africa. One of our clients has a safari camp there in Zambia, Africa. And it was wonderful. It's a great trip. Highly recommend it. If you are interested, reach out and we'll share with you how to go to Zambia and actually visit with my client and their safari there in Zambia. But it's interesting, those people all had cell phones. I was really surprised, but they didn't have electricity. None of them had electricity. They would walk, I kid you not, 5 miles to go power their phone. And some of these kids, teenagers there in Africa, every day, they would go walk 5 miles to charge their whole phone so they could come back home. They're all connected. They want the electricity, they want the power. This is going to be something that I think is going to expand all over the planet to provide reliable electricity for everyone. So I do think there is a real opportunity, not just in data centers in space and SpaceX IPO, but in traditional energy production. Let's get all the numbers out as far as what people are looking for on what's available in the market today. The MYGA rates, the multi-year guarantee annuities, currently it has not changed from the last video. It's a 3-year available at 5.5%. This is a great interest rate, guaranteed, insured. You put your money in for 3 years. It's like a CD with an insurance company. You get 5.5% per year. It's a 3-year time frame. Great deal. The 5-year, same story. It's 5.7%. So really nice rates that we're seeing on guaranteed interest right now. Make sure you're taking advantage of this. 3 years at 5.5%. 5 years at 5.7%. And then of course on the buffered indexes, we love this product. It's done so well for our clients. The current offering we have on the 2-year, which is the buffered index, this is the one that has an 18.5% cap over the next 2 years. That means that you can earn up to 18.5%. And if the market goes up 10, you're up 10. If it goes up 15, you're up 15. But if the market goes up 25%, you're only going to be up 18.5%. So that's our cap. In exchange for giving up everything above 18.5, we're able to get a 20% dual directional insurance policy. This means that as the market drops, you actually get the inverse return. So over the course of 2 years, if the market is actually down 10%, not only do you not lose money, you make 10%. If the market's down 15%, not only do you not lose money, you make 15%. Now, in the event the market is down more than 20%, it's just a 20% reimbursement, not the inverse. So if the market's down 25%, well, you get reimbursed 20%, you're still down 5%. The reason I love this product is because what if the market is down 25%? No big deal, we're only down 5%. Great investment. It helped protect you in a real bad economic environment. What if the market's down 15%? Hallelujah. We're up 15%. That's a 30% alpha. Fantastic investment. What if the market's up 15%? Great. We're up like everyone else. We're up 15% too. What if the market's up 25% and you're only up 18.5? That's okay. We don't have to be greedy. That's enough. It makes all our retirement work. So we love this product. It is a 2-year. The other product is we're excited about. We worked very hard to get this product available. I know it was not available, and now we have got it back. And the current barrier product, which is the 185% participation rate on the S&P 500, that's the current pricing we have. It's a 5-year hold, and you actually can beat the S&P 500. This is a fantastic product. If the stock market's up 50%, you're going to be up 90%. If the stock market's up 100%, you're going to be up 185%. This is a great product. It is a 5-year hold. So this is really for money that you do not plan on touching for the next 5 years. It's money you just want to grow. You want to beat the S&P 500. It's great for Roth IRA money that we're not going to touch for a while. It's great for maybe people that have a set amount of funds that they don't need. They're not going to need this for 5 years, and they just want to beat the S&P 500. I love the product. I use it personally myself. And so that barrier product, we worked hard to get it. There's no guarantee it's going to be available in the future. We actually went through a time frame where 6 months we couldn't get this product. And so it is available right now. If you are interested, reach out. Let's take advantage of it. That barrier, I think, is a very good deal. And lastly, I'll mention our Copley Tactical Fund. Exciting, just broke 30% returns for the year. Very exciting. And so we just rebalanced it. We hit that 30% level, which is just way higher than all the indexes, which is great. We're real excited about it. A lot of it has to do with our outsized positions in gold, which we are continuing to have those positions, but we did rebalance it. We reduced some of the current gold positions. We added some different positions in, and we actually added in some newer positions in gold in some of the junior mining companies, which I think is going to be a really good place to be. A lot of these companies, the estimates that analysts and people on Wall Street are using is that gold is going to be in the low $3,000 range. And if gold prices are in the low $3,000 range, these companies are a very good buy. Well, gold is currently over $4,000. So if it just stays right where it's at for the next year, the numbers are going to be substantially better than what all the projections are that Wall Street has on these gold mining companies. So we're pretty excited about this. And if gold prices go up, if they go up to $5,000 next year, which I think is a real possibility, you're going to see just record profits. And so we're positioning a lot of the accounts. We recently rebalanced them all for that. So we're excited about it. We think there's some real opportunity out there. We also really like the energy space. As I mentioned earlier, I think there's a real opportunity. Energy is one of those things that no one wants to own right now. Oil prices are down. All the stocks of these energy companies are down. When prices are low, it's the time to buy, not the time to run away. You want to buy when you see an opportunity. These companies are making a lot of profits at these current prices. So what are the chances of oil prices dropping further? They could go down further, but I don't know how much further. Could they go way up? Absolutely. There's going to be a lot of energy demand, not just the data centers potentially, but just demand for more electricity all over the world. So all of those are great opportunities. We're going to be taking advantage of those. And so if you're interested in any of those type of products or investments, reach out to your financial advisor or simply email us at support@copleyfg.com. I hope that was a great market update. Again, my name is Matthew Copley, and I look forward to seeing you in our Mission Valley office very, very soon. And soon to be new office just outside the Golden Triangle at the 52 and the 805. Again, we're probably going to move in March. We'll keep everyone updated, and we'll send out as soon as we have dates for that client appreciation grand opening that we're going to do at that location, new location. We'll get that out as soon as possible. So thank you all for watching.